Hello everyone, welcome to this channel. My name is Ruben and today we are going to talk about the big ideas from ARK Invest from 2021. This series will consist of 15 episodes and this one will be about part 6, Bitcoin preparing for institutions. ARK believes Bitcoin's rapid growth has positioned it for an allocation in investment portfolios, and they believe that Bitcoin offers one of the most compelling risk-reward profiles among assets. And according to their analysis, it could scale from roughly 500 billion to 1 to 5 trillion in network capitalization during the next 5 to 10 years. And in their view, capital allocators should consider the opportunity cost of ignoring Bitcoin as part of a new asset class. Bitcoin continues to gain credibility. The market has validated this across 4 different entities such as regulators, banks, institutional investors, and public companies. ARK believes that Bitcoin deserves a strategic asset allocation in institutional portfolios. Untethered from traditional rules and regulations and generally uncorrelated to the behavior of other asset classes, Bitcoin seems to have earned a strategic asset allocation in well-diversified portfolios. And during the past decade, Bitcoin is the only major asset with consistently low correlations to traditional asset classes. Well, they did a study on this and they put this here in a correlation matrix, and a correlation basically measures how the returns move in relation to each other. It's always between +1, that means that the returns always move together, and -1, that the returns always move oppositely. And independent risks have no tendency to move together and have zero correlation. If we have a closer look at the correlation matrix, ARK makes a distinction between 3 categories. One is high correlation, which is green, with a coefficient value that lies between ±0.5 and ±1. The second category is gray, which is moderate correlation, that has a coefficient value that lies between ±0.3 and ±0.49. And the lowest correlation, which is purple, that has a coefficient value that lies between ±0.29. And if you look deeper into this table, you can observe that Bitcoin has the highest positive correlation with real estate with a value of 0.34, and the lowest negative correlation is with bonds with a value of -0.14. Michael Saylor, the CEO of MicroStrategy, is very bullish on Bitcoin.
Is there anything good about holding Bitcoin itself if it's not going up? In other words, during these drawdown cycles, is there anything about the asset that makes it an attractive thing for you to hold?
First of all, it's the hardest money on earth. It's an institutional grade safe haven asset. It's gold without all the imperfections of gold on a digital monetary network that moves at the speed of light that you can program to do 1 million transactions a second. So Bitcoin is digital gold on a big tech monetary network. Why would you want it? You would want it for the same reason that you want to run electric power to your city, or you would want to run running water to your building, because civilization is based on clean energy, clean water, clean communications, clean money, right? It is an extraordinarily important thing. Now, with regard to companies, I think the real issue here is if every currency is correlated to the dollar, right? I mean, they're all trading against the dollar. So if the dollar is weakening, every other currency is weakening, and then every stock and bond and commercial piece of real estate that generates fiat or US dollar cash flows or any cash flows in a fiat currency, they're all correlated assets, and they're all correlated ultimately to the dollar. So if we create 15% more dollars every year for the next 10 years, right, then you've got to discount the cash flows of every other instrument by 15% a year. And it doesn't take a rocket scientist to figure out that 80 to 90% of the value in those instruments is going to be collapsing if the dollar collapses. So if you want to preserve shareholder value, you have to buy scarce assets. Now, I could look for baseball cards or Picassos or sports teams, but it's hard to buy $1 billion of liquid, scarce trophy assets. So Bitcoin is the most liquid, scarce uncorrelated asset that you can buy if you're trying to do this in a treasury.
Bitcoin trading volume is comparable to that of a large cap stock and has grown at an exponential rate. ARK estimates that Bitcoin's daily trading volume could exceed the volume of the US equity market in fewer than 4 years, and the volume of the global Forex spot market in fewer than 6 years. They put this in a graph. On the x-axis you have time, and on the y-axis you have US billions of dollars. And the purple color represents the Bitcoin spot market US dollar daily volume on major exchanges. And right now it's trading with an average volume close to that of Square and Apple. The current daily volume of Square is around 6 billion, and Apple peaked in 2017 with a value of 8 billion. For institutional investors, it's possible to access Bitcoin in sophisticated ways. Bitcoin open interest, or the total outstanding value of future contracts, hit an all-time high on the Chicago Mercantile Exchange, also known as CME, in October 2020. It increased tenfold and hit nearly $1 billion in 2020. Integrated into established financial infrastructures, the CME allows investors of all risk appetites to gain exposure. And they put this in a graph. On the x-axis you have time. On the y-axis on the left you have the Bitcoin's future open interest on the CME, and on the right side you have another y-axis which is the Bitcoin price in US dollars. And the purple color represents the open interest, which is increasing over time, and then you have this green line which is the Bitcoin price, which is also increasing.
I don't think a company can be successful if it doesn't have a large asset portfolio and an environment where you've got such aggressive monetary expansion. If you had an environment where money was expanding at 0% a year, then you could focus upon the manufacturing of things. But in an environment where the money is expanding at 20% a year, everything you're doing in the future is being discounted by 20%. So in essence, as the money supply expands, all the future activity of every business is being discounted until it exponentially goes to zero, which means that the only path you have in order to create or preserve shareholder value is to forward finance your cash flows. Like, you have to look out 20 years, borrow against 20 years of cash flows, and convert it into an uncorrelated asset, which is going to appreciate faster than the rate of money expansion. Otherwise, and you can see this in Venezuela or Argentina,
right,
the business as an enterprise, or the enterprise value of the business, goes to zero as the money supply expands. You don't have a choice.
ARK believes that Bitcoin has earned an allocation in well-diversified portfolios, and based on daily asset class returns, ARK simulated a portfolio optimization, and they put this in a graph. On the x-axis you have annualized volatility, and on the y-axis you have annualized returns. Here you see the efficient frontier together with the Sharpe ratio and the minimum volatility. And based on daily returns across asset classes during the past 10 years, their analysis suggests that allocations to Bitcoin should range from 2.55% if you want to minimize volatility to 6.55% when you want to maximize your return. If institutions are really going to allocate money to Bitcoin, this could have a substantial impact on the Bitcoin's price. A 1% allocation should lead to a hypothetical impact on the price of $100,000. If institutions want to minimize volatility and allocate 2.55% of their money to Bitcoin, this will lead to an increase of $200,000. And if they are really aggressive and want to maximize the Sharpe ratio and allocate 6.55%, this could lead to a hypothetical impact of $500,000. Thank you everyone for watching this video. I really hope you enjoyed it, and see you on the next part.